All right, folks, welcome back to the channel. This is Jason, certified financial planner, host of Fighting Words Financial. And once again, of course, there is no warning, there's no schedule. I'm doing a live stream here. Happy to talk about anything that you folks want to talk about today. So let's talk about anything you want to talk about. Fire away, ask some questions. Today, I was reading a pretty interesting article on Barron's talking about the crackdown by the Chinese Communist Party on different companies around China. A lot of the ones that we're invested in, of course, a lot of the ones that were traded here on U.S. markets. And Barron's, they had an interesting point. So one of the things that nobody seems to be able to figure out is why exactly is China cracking down on these various companies and what is their ultimate goal? I actually didn't necessarily agree with this Barron's article, but I'm going to talk about their points because, hey, we should always talk about things that even though we disagree on. And they were basically saying that the crackdown by the Chinese Communist Party on these different companies was related to a sort of social justice movement that they have going on right now. They wanted to create a more secure and trusting environment for a wider variety of investors to get involved in the market. They want to encourage consumerism, and they want to have the appearance of transparency, which I think is really odd since they have they basically treat company financials like state secrets. Florian, hi, how's it going? Or Florin, how's it going? And Annie, hi, how's it going? LL, not sure who you are, but it looks like you want to talk about DDD, which is the 3D printer. So I tend to hold all of my 3D printing assets through an ETF, and right now that is ARC's ETF. And let me talk about why that is. I was a really early investor in 3D technologies as soon as some of these companies became public, and I got burned very, very badly. At one point, I don't remember what year this was. I want to say it was probably around like 2012, maybe 2013. I actually bought 3D, the printer, at like $91 a share or something like that. It was pretty close to the high. In fact, for the longest time, I actually suspected that I was that poor sap who bought that stock at its high point, and it only declined from there on. So Shoeless Joe checking in from Great Britain. Thank you very much, Joe. If you guys have any questions, let me know. I got about a free hour today to talk about anything that you guys want to talk about financial, whether that's just stock related, whether that's financial planning related, retirement related, whatever that is. Some of you folks are here in the US, some of you folks are located overseas. So I will try to help you out, but shoot, anything you want to talk about, I'm willing to talk about. There's a lot going on in the markets today. So I'll be honest with you, I'm a big fan of SoFi, but two companies that I'm interested in a lot lately are Square and PayPal. They are making some strategic acquisitions right now and making some power moves right now that I think are going to help them out in the future. They're also sort of rearranging the type of demographic that they're targeting, right? So Square's demographic they've been targeting has really been the unbanked. Let's talk about this. It's really been poor people, right? One of the things that's not really well known unless you work in the financial industry is that it's very expensive to be poor in the financial industry. And those are the folks that tend to be charged the larger fees because they generate less in the way of commissions on products sold. So those are the ones that tend to be unbanked, and there's money to be made there. And for the longest time, they were exploited by like check cashing services and things like that. Square sort of stepped into that demographic to begin with. PayPal targeted sort of a higher demographic above that, and then SoFi is targeting an even higher demographic, the 100,000 plus earners. So all those folks for the longest time really weren't competing against each other. They were looking at different markets. Now they're all starting to move towards the middle and fight over accounts, and I think this is going to be very interesting. Florian says that this seems to be an important week. Inflation fears are back, changes all around. So I do think that inflation fears are back. I called it a couple of months ago, saying that a lot of inflation was due to supply chain disruption, and I thought that most of it was going to be temporary. I might consider, ask me 6 months from now, and I might consider backing off from that statement. But I am looking at a lot of this being due to supply shock at this point and not actual real inflation. We are looking at something right now that none of us have ever experienced in our entire lifetime, which is this massive disruption of the supply lines. We're literally, this looks like the United States coming out of World War II to some degrees when we're looking at the changes in supply lines here. So I think it's just going to take a lot of time to figure out what the heck is going on with inflation. I wouldn't jump to any conclusions right now. I wouldn't make any major money movements. And I'll let you guys know that I actually have not taken anything out of the stock market at this point. I've made a few additional investments, and let's talk about that. So Andy Parent says, what are your thoughts on RYCEY? So actually, I don't know anything about that. So let's take a look at that right now. RYCEY, not a company that I follow. So let me look at that right now. Hold on a second. RYCEY. And for some reason, that ticker symbol is not coming up right now. So just give me a minute, and I'll come back to that. Okay. Shoeless Joe says PayPal moving into crypto in the UK. PayPal is also moving into crypto here in the US. Not only are they going to allow you to trade crypto, but it looks like they're going to allow payments to go through in crypto. So I think that is that's going to be pretty interesting. So, hi Jason, what do you think about vaccine stocks like BNTX and Moderna? So Moderna's actually been around for a really long time. A lot of people don't realize this. I think it's about a 21, 22-year-old company. And for the longest time, they didn't have a product at all until, of course, COVID came along. Part of it was they really couldn't get anything approved through the FDA's process. They weren't willing to take a chance on anything because being denied costs you so much money. And for 20 years, they were basically just a science project. Now, this is a technology that I've actually been interested in for a really, really long time. I think I've shared this on a previous live cast. That the first papers were written like that 88, 89 timeframe. And I first read about the technology somewhere around 1993. So I've been following this for a long time. Actually, vaccines are not where I thought that the mRNA technology would go. I thought that it would go a different direction, like in terms of gene editing. So I think it's very interesting that Moderna is being used this way. I also think that it's very difficult to predict if any vaccine stock that's successful today is going to be successful tomorrow. I just think that there is. I think that this industry is changing a great deal, and let me talk about why that is. So on January 8th of 2020. Everyone in the world who basically could manufacture a vaccine essentially had the entire genome of COVID-19. It was released by the Chinese government to the World Health Organization. They released it to essentially everyone out there, and everyone started racing to produce a vaccine. Now, as far as I know, sometime in mid-March, there was already an mRNA vaccine available for this. At this point, this technology has been tested dozens of times on animals. It's been tested in trials on humans, not for COVID-19, but for other diseases and that sort of thing. But this was the first sort of application that they knew they could have almost a risk-free path from developing this vaccine. When I say risk-free, I mean financially risk-free because of Operation Warp Speed. That the bill for this was being footed by the federal government and actually governments around the world. And this is the first time they were able to take this technology from beginning to end without taking any financial risk. And I think that's one of the reasons that it happened so quickly. But we're looking at a world where I think that more and more companies are going to be adopting messenger RNA technology, and more vaccines are going to be produced in this manner. Not quite as quickly and not with emergency use authorization. But I'm saying using just this particular method, I think, is going to become more and more prominent. So what do I think about the stocks? I think that it's just like with any biotech stock or or pharmaceutical. It's really difficult to predict whether those are going to be long-term winners. I think a lot of these companies are going to be bought up by the likes of Pfizer, by the likes of I just can't think of Johnson & Johnson, by the likes of other drug manufacturers in this process. Could be a great win for everyone, or you may be disappointed depending on what your expectations are. Dominic Auerbach says, glad to see you back. I'm glad to see you too. You're actually a frequent commenter on my videos and my live streams. I'm happy to be here. Just happen to have a free hour, guys, so ask anything you want, and I'll try to get to everyone. Just as a reminder, too, the super chat features are on if you guys are so inclined. So Tell666999 says, hi, just joined the live stream, so you may have discussed this already. Any thoughts on how the Chinese government seems to be cracking down on certain Chinese stocks? Should we be worried? So I did talk about that a little bit earlier, and I was talking about this Barron's article that I read that I kind of disagree with it. They think that there's this giant, like, social justice aim essentially towards the crackdown. I don't buy their logic on this. I don't think that their aim is really clear. I think that the Chinese Communist Party is not really communist if you have private property, if you have a stock market, but they are still a dictatorship. They are still a totalitarian government, and they like to throw their weight around occasionally when they think that people are becoming too, I don't know the word for it right now, or becoming too aggressively individualistic. So I think that has something to do with it. I do think we should be worried to a degree. There was almost $1 trillion of wealth wiped out over the course of the last 3 weeks, just based on the whims of a few people high up in the government. I think that's always a risk when you invest in Chinese stocks. I think that political risk should always be calculated into any holdings that you have. And let's remember, they just aren't us. They aren't the West, and their rules are different, their aims are different, and even the aims of their regulatory organizations are far different than we are. So, Mitos27 says, "Hello, I'm curious about China's position when it comes to oil and EV industry. Does China cover their own demand for oil as considered a national security risk? Therefore, that's exactly what it's considered. In fact, if you read some of the speeches that were made, like the 2014 to 2017 timeframe, by some of the that entrepreneurial class, like He Jianping, William Li, and a couple of like higher up Chinese, the Communist Party officials, and they were definitely stating that their lack of oil resources, lack of domestic oil resources, is one of their constant anxieties. And having this green energy revolution for them, where you're using solar to produce power, all kinds of other methods to produce power, and an electric vehicle industry, not just about cleaning up the environment, but in a way, it's also about securing an energy supply. China is no doubt looking at countries like Ukraine and Belarus that are 100%, not 100% anymore, but largely dependent on gas exports from Russia, which allows Russia, a really small country with a really small economy and huge issues, internally. I think life expectancy for Russian males is something like 61 or something ridiculous like that. I'm sure it's higher now. That's what it was about a decade ago when I read these statistics. It was absolutely mind blowing at the time. But they're a country with really small economic might, whose importance is vastly magnified by the fact that they control these natural gas supplies, and Europe is really dependent on those. And they're able to use those a geopolitical strategy around their control over these supplies in order to get what they want in a lot of ways. So I do think that China is looking at this, and they, for the longest time, they just simply didn't have a problem being dependent on that when their oil demand or oil consumption was pretty low. Now that it's higher and higher and higher, I think that they probably planned for this a long time ago. I think the original plan was probably to use their influence in Southeast Asia to secure oil supplies. Now they see that is probably not the best way to go. And I think that had a huge impact on their decision to support the EV revolution. And let's be clear here, Tesla is still a technology leader, or apparently a technology leader here. They may not be that technology leader here in the future. China is investing hundreds of billions of dollars, and they're recruiting manpower. They're creating entire cities just to manufacture EVs. I think it's a very exciting time. So let's see. Shula's Joe says, I've noticed that some people are quite pessimistic about the short-term future of the stock market. Do you share that pessimism? Well, the answer is no. But the answer to that is generally going to be no to me. I'm a pretty focused long-term investor, and I know that especially after living in the time period that I have, which is got into the industry, started investing stocks in the mid 1990s, went through the dot-com crash, went through 2008, gone through the panic of 2020, and so I pretty much know at this point that I can be rational far longer than the market is irrational. And I'm not taking so many chances that I can't remain solvent for as long as the market is irrational, right? So any of the money that I put in stocks, I don't need that to fund my lifestyle, right? So so that's one reason why my view on this might be a little bit skewed. Now, if you're the type of person who trades in your portfolio to generate income out of it, you may be a little bit more concerned about the short-term, short-term future of the stock market. But I was having a conversation while I was on vacation with someone and talking about, and of course, when I was in South Carolina, of course, it got into politics. And this guy said, "Well, since the new president took office, all I've done is lose money in my investments." And I look at him, and remarkably, for once, I just kept my mouth shut and said nothing that would have caused something additional to be said about this. But I'm thinking to myself the whole time, if that is the case with your portfolio, then you simply aren't properly allocated, and you probably need a new financial advisor. Or in this case, the guy probably didn't have a financial advisor and he's investing entirely in meme stocks or something like that. The stock market is still hitting all-time highs. It's still doing that pretty regularly and has for the last 6 or 7 months. When you look at all the pieces that are in place for the economy reopening, when you look at all the pieces in place for what's going to happen with the supply chain over the next 6 to 8 months in terms of improvements, are you looking at like wages going up because there's labor shortages everywhere? No, I'm actually pretty optimistic about the stock market. And I think that actually the bottom line, which is company numbers, are going to start to improve, especially in areas that we haven't seen improvements in a long time, like restaurants, hospitality, and things like that. So I think in a way, like we may see technology, which if you're listening to my channel, you're probably really interested in technology. We may see that lag a little bit. And many of the industries that have been beaten down over the last couple of years are going to come roaring back. And they already have to a great degree. But little things, I don't know if you guys follow Yeti stock. This is not a stock that I would have followed, but a good buddy of mine, when I got him involved in investing for the first time, I said, hey, buy some of this ETF, buy some of this, whatever. And he went out and he bought Yeti stock all on his own. This is not something that I would have considered. It's a real specialized type of cooler. I don't want to spend $600 on a cooler. They may not cost that anymore, but this stock has absolutely taken off and it's outperforming everything else in his portfolio at this time. But that's a forward-looking stock. That's a stock that says people are going to be out moving about, doing things with their lives. They're going to be traveling. They're going to be enjoying themselves. This is a real optimistic type of forward-looking investment. And I think that's a better indication. The performance of that stock is probably a better indication of consumer sentiment than anything else that's out there right now. So I'm not pessimistic, but I'm generally not pessimistic about the stock market in general. When things go really sour, I just kind of ignore things for a couple of months and get back on that. So considering inflation, how should we prepare ourselves? For instance, is now a good time to buy a house, especially in a hot area like San Francisco? Well, that depends on what you can do with your house and what you want that house to do. So I own a couple of rental properties. And one of the things that I like the most about rental properties is that it's very difficult to get into a rental property in my area. You have to have you be able to save money for a down payment to do that, or you have to live in a place for a couple of years, move out, scrape by, not really cash flowing on the property for another 4 or 5 years until rents go up. But the nice thing about rents is that rents pretty much always go up as long as you maintain the property. And when I say maintain the property, don't do what a lot of individual landlords do, which is just do the bare minimum of fixing things. Actually fix things, make things look nice, take care of the people that rent from you, and they'll be loyal. And you can also incrementally raise the rent and help yourself keep up with inflation. So the rents that I charge have outpaced inflation and they've done so for 15 years or so. And basically, you have an asset where you took some financial risk getting in, you had to put some money down getting into this, but after time, your renters are really paying all of those expenses for you, and it starts to cash flow, and now you have an income stream that is keeping up with inflation. So that is one of the ways that you can keep up with inflation. Real estate investment trusts are another asset that performs very, very well in an inflationary environment. financials perform exceptionally well in an inflationary environment where we're going to see rising interest rates. I don't know that that's going to happen as soon as a lot of other people in the market expect that to, but I will probably start shifting, and I already have with my investments in SoFi, a recent investment in PayPal. I've started to shift little by little more towards financials. I may even be looking at more traditional type financials here, like major investment houses and things like that. So that's something I may be looking at in the future. I haven't really decided. So things that I would avoid right now, of course, fixed income. I've been saying avoid fixed income since 2008. I think that is still the case. It's going to be very, very difficult to make any sort of money on fixed income for the next couple of years. Another thing that I think we're at the top of the cycle for that I would probably start avoiding right now is junk bonds. So this is probably something that I haven't talked about on my channel for a long time. But junk bonds or corporate debt securities that are issued by companies of less than stellar credit quality. In a really good environment or of an environment of low interest rates, these assets tend to perform well. I think in the case of junk bonds at this point, all of that has been priced in and you're not getting a great deal right now. And in an inflationary environment, you're going to start seeing corporate debt being issued at higher and higher coupon rates, which means the existing debt that you own is probably going to decline in price. So I think that, I think that just owning stocks is great. I think that owning financial stocks in this inflationary environment, if it really is a truly inflationary environment, is going to benefit you. And particularly, I think that owning some of the bigger bank stocks may actually be pretty good at this point. So one of the things that people don't recognize is that as we see interest rates rise with banks, you're going to see a wider and wider spread between deposit rates, meaning what you're getting paid for what you have on deposit versus what it costs for you to borrow money. You see that wider spread, even though there's not really any greater risk in this time period other than inflation risk. But what that really does is it improves the bottom line for financials. This could be a really good period over the next 6 to 10 years, could be a really good period for financials, including all of these new fintech companies that are coming out or some of the more established fintech players like PayPal and Square. And I'm all over PayPal and Square. I love those companies. I've been more focused on SoFi right now. I'm a little bit biased on that. That's simply just what I'm interested in right now. I'm not saying anything bad about SoFi or about Square or PayPal. I think they're great companies as well. And if you guys know of any others, we should talk about those as well. So see here. Moyala says, considering inflation. Okay, we already said so. Anvar, hold on, lost my place here. And so I made a small entry in the GGPI SPAC for Polestar EV today. Have you had a chance to peek at them yet? Any thoughts? I'm going to reserve my thoughts on that right now. So I really need to go back and review my Geely video that I originally did to talk about Polestar as well. And I just can't remember the name of the Swedish company they own right now also, but Volvo or whatever else they own there. I need to go back and review that video and that research to really start talking about Polestar again, but I'm going to do that. I've been off the SPAC bandwagon just for a little bit because I've been concentrated on a few different things. So readdressing the balance of power. I assume you're referring to China. Yeah, that was part of what, So, okay. And Inivan says, can you share your comments on Novonix? Not at this time. I don't really have mature thoughts on this right now. Oh man, Fresh Aquariums, I knew you were going to ask me about Huya. I knew you're going to ask me about Huya. So I've looked at it to a little more. Once again, not ready to do a full video on this. So look, I'm getting, and I'll be honest with you, I'm getting a few warning signals from them, which may be completely just my bias here. They may not be reality. So I want to take a little deeper dive on that. I'm going to come out with a full video on this company here pretty soon, and I'm going to be as neutral as possible. And keep in mind when I'm doing this, I'm skeptical, pretty skeptical going in on this. So so I'll talk about that. You're right. It does look like a value play, but remember that almost every Chinese stock that's traded on U.S. markets is and always is, priced in a way that reflects the uncertainty of that arrangement, right? So Alibaba, based on what they report in earnings, should always be it should be really close to, like, we should see Amazon numbers here, right? But we don't, because there's always that consideration of that political risk, geographic risk, and all that. So China says, well, sure, if you're stealing everyone else's technology. Yeah, so not I mean, I understand what you mean by that, but in EVs, that's really unfair. Tesla gave away all their technology. They opened up all of their patents for public use in 2014. And they made a lot of their own innovations since then. I know that they had an issue with XPeng had an issue with being accused of copying their autopilot program. But I think since the recent updates, those issues have largely gone away, especially since the adoption of LiDAR is coming soon. I think that's really gone away. So what do you think about the rumor that Tesla will buy the BYD Blade batteries for their Model 2 in China? And what do you think that would mean for BYD? Well, this has always been BYD's plan. They have, they produced the Blade battery with the intention of selling it to third-party manufacturers. That was always their intention. They're in talks with several manufacturers to do that for two reasons. It's a great product. It's safe. It has... There have been other lithium ferrophosphate batteries that are out there. They've been out there for a long time. Like I use, a couple of them on my boat right now because it's twice as energy dense for half the weight. It's a lot more expensive, but you get thousands of cycles. So you're looking at the Blade battery should have a cycle life of somewhere between 3,000 and 4,500 cycles, right? Let's say the Tesla Model 2 comes out at 220 miles of range or something like that. You're looking at well over 1 million miles on that battery. So you're looking at a battery with really, really long cycle life with energy densities somewhere around 14% less than the best batteries that are out there today, in one that's extremely safe. You can shoot it with a bullet and it doesn't really get that hot, and it doesn't really catch on fire. So, and it's cheap. It's really, really cheap, and it doesn't have any cobalt or manganese in the cathode chemistry, which are either difficult to obtain and it doesn't have nickel either. They're either expensive, difficult to attain, or politically sensitive. So, Fresh Aquariums, thank you for the super chat. Thank you so much, buddy. So Max P says, I have to. So when I'm talking about being a small country, I'm saying its economy is pretty small. It really is. Like the economy of Russia is really tiny in consideration with its overall influence in world markets. So all right. So hold on a second here. Yeah. So in terms of BYD batteries for the Model 2 in China, we're going to see the Blade battery not just being used for the Tesla's Model 2. We're going to be seeing it used all over the place. BYD is already the either fourth or fifth largest battery manufacturer on the planet. They make batteries for everything from watches to electric vehicles. The reason that Warren Buffett originally got into BYD wasn't because of their vehicle lineup. It was because of how much production of batteries, lithium-ion batteries, they controlled. So I do think this is going to be good for everyone. I think it's going to be really good for BYD. And I think it's going to change. I think it's actually going to change the balance of battery or cathode chemistries in the EV market. It's just too cheap, and the battery is just too good. And when I say too good, it's not the best battery on the market in terms of energy density, right? But it's one of the safest batteries on the market and one of the cheapest, and it's good enough in terms of energy density. So I think it's going to be really great for BYD, and I think that if they're selling it to Tesla, they're going to sell it to lots of people. So advice for new investors: what's the best thing to do at market crashes for specific sectors, stocks to invest in during a recovering market? So Cambo Jam, that depends on whether you have money sitting on the sidelines or whether you're fully invested. If you are properly allocated and you have a truly balanced portfolio, like my portfolio is extremely aggressive. Like I have a large cash position and the rest of it's in stocks, right? But it's well diversified across, geographies, across industries, across market cap size, across, specific micro sectors. It's extremely well diversified. And I've taken a couple of outsized risks with individual stocks, but the vast majority of my portfolio is actually in ETFs, right? But anywhere from 65 to 70% of it at any one time, right? So in a market crash, one of the biggest mistakes you can make is actually doing something. In most cases, for most people, if you already invested in the market, a lot of what you should do is a big fat nothing. It's just wait things out, keep investing, dollar cost average, if that's what you're doing. If you have money sitting on the sidelines and you happen to be there during, happen to have money, and I'll admit, guys, this is what got me really started investing in stocks. Is that during one of the crashes in the last 2 decades, I simply had a lot of money sitting on the sidelines and was able to buy a lot of things at a discount. And I wasn't horribly original about it. I bought a lot of really well-known large cap names, like, your Wells Fargos, like your Morgan Stanleys, like your Home Depots and things like that. Things that I knew were going to survive, any economic crisis and were going to come back, right? That was not horribly original. It's not sexy, but it did make me a lot of money. And it also gave me the confidence to go back and start taking those larger and larger risks. And this all happened during, for me, during 2001, 2002. The market was down. The S&P 500 was down 9%, 11%, 22%. So a 3-year downturn in the market. That's a long time. And most of you watching my channel today, and I know this based on the demographics, are not old enough to have been invested in that time period, and you've never experienced a market that was down for that long, right? So I do anticipate that a lot of you are not going to be able to remain disciplined and focused. Either you're going to think that many of the stock choices that you made are not going to survive that downturn, or you're going to lose your job or something like that, and then you're going to be forced to liquidate. And that's a whole different ball story. It's a whole different ball game. A lot of people are forced to liquidate stocks at a disadvantageous time simply because they don't have something like an emergency fund and savings. And coming out of what we've come out of in the last year and a half, there's a lot of people that, even though savings rates are at an all-time high, that's really limited to people who already had financial assets. If you are just a working stiff and was paycheck to paycheck before 2020 happened, you probably don't have much of an emergency savings left. And if you do have any stock, things in the stock market, and the market does decline, maybe it affects your job. Maybe you're forced to liquidate that time. So that's really kind of a tragedy. If you think we're kind of going into bad times and we're looking at a stock market crash, I would start accumulating cash at this point. That's one of the things that I start accumulating. But you face the danger of inflation risks too. Whatever is not invested right now, if you have cash sitting on the sidelines and it's not invested somewhere, you're losing money because of inflation, right? Real or not, temporary or not, you are losing money at this point because of that. So the answer to that question is never going to be 100% clear. Like, what do you do in market crashes? What I do in market crashes is nothing really, except maybe buy more, and that's it, right? What you do in a market crash is really going to be dependent on your individual situation. And if you don't have an emergency fund, and your job could be affected by a market crash, then I would suggest that you start acquiring an emergency fund. Really boring advice, I know that, but sorry. All right, so Fresh Aquarium says, I remember in 2015 when the Chinese market crashed, I thought I was a Jedi buying Baba and selling at 110. I see the same thing here for companies like BEKE, and I think this is accumulation opportunity. It could be. And I've always been, and let's talk about the threat of deregulation here. Or not deregulation, of delisting, rather, not the threat. Deregulation is not a threat. I'm talking about delisting. I think that threat is growing. When that was first mentioned and Congress first passed that legislation, I thought it was a bad idea. So the Chinese government does not respond well to, and never has responded well to, this type of ultimatum issuance, right? And I thought that this would at least bring folks to the negotiating table, and by the end of this 3-year period would have some sort of negotiated settlement. As far as things go now, that's looking less likely. It's not to say that there won't be some negotiated settlement sometime in the next 2.5 years, or even at the last second or something like that. But I think that the risk that some of these companies are going to be delisted is growing, right? And I haven't made any moves yet. I haven't sold any Neo or Xpeng or Alibaba or any of the other stocks that I own that are U.S. listed Chinese stocks. But that concern is growing for me. So now, if you own a company like like BYD, you own either the ADR or H shares, which are like Hong Kong shares, depending on, and I forget which one is which is BYDDF and BYDDY. But Neo actually is traded under a completely different arrangement here in the U.S. So that's something that you want to keep in mind. I'm not buying any more Neo. It already represents a really outsized portion of my portfolio. I want to acquire some more Xpeng. I'm going to do that kind of slowly and cautiously, just because I do think that the threat of delisting is growing at this point. I was reading an article that says they think that it's kind of inevitable at this point. I don't think that it's inevitable. Typically, this is something, an economic dispute that would get ironed out over negotiations and a new trade deal, right? So what we had during the last administration was a lot of threats, a lot of sanctions, a lot of talk of a trade deal, but nothing was really ever signed. And even if it was signed, it's not implemented, and it's not being enforced. So I think that we have to go through this negotiation at some point. So yeah. Okay. So David Papa says, "Hi Jason, can you do a video on the best ETFs to invest in?" What I might do in this case is probably a video on like ETFs for different sectors, kind of like maybe top ETFs. Let's talk about what makes a good ETF, or something like that. So that's a pretty broad thing. I don't like to be that broad. So do you have any tips for people who have full-time jobs but want to set up multiple streams of income to get ahead? Yeah, I do. How I got ahead was possibly the most unoriginal way on the planet. I got ahead essentially by, and this is what happened, and I've told this story before, and I kind of got ahead a little bit in 2001, 2002, but I really got ahead during the 2008 crisis. And I did it in the worst, not the worst possible way, but the company that I work for essentially cut my compensation stream by about 2/3 because they changed how we were compensated on this particular product that I built my entire financial advisory practice on. So my income went from 6 figures to like $32,000 a year, which if you live in Southern California, that was barely enough for me, my wife, and my daughter to survive on. And we went through this pretty radical budgeting process where we cut out everything. Because I mean, literally, I went and I complained to this, and the people that I complained to were like, "Well, we don't even have the power to change this, but this is also the middle of a recession. What are you going to do about it?" Right. So number one, that's the second that I resolved to get a better job, to not be dependent on jobs again. But it's also when I realized that I didn't even understand all the money that was going out. I needed to figure that out. My wife and I created what was essentially a starvation budget, where when I say starvation, we weren't starving. We were eating really well, but we literally figured out how to eat on $25 a week. Me, my wife, my daughter. It involved a lot of vegetables and rice. Okay. But it taught me a lot about what makes me happy in terms of the material things that I need. And as it turns out, it wasn't anywhere near as much as I thought. It took us about a year and a half to get to the point where I was making more money again. But at the end of that year and a half, I realized that we weren't any less happy than when I was making lots of money before. Okay. So in that case, we just decided not to really change very much about our spending habits. And even though my income doubled, tripled after that point, we really have not brought our budget back up to that point. We went from spending about $32,000 a year, which was everything we had, to now spending roughly double that. And it's been 13 years since then. We added another child, and I've added another. We have a house, right? So large part of that was controlling subscription expenses, monthly bills, and if it's a monthly bill like Netflix, I'm not paying for it. There's a lot of things that I'm just not paying for. I'm not going to commit myself to a monthly bill for lots and lots of things. So controlling my budget allowed me to sort of work my way up that corporate scale to start I started saving a lot more money in that time period. And when I saved money, I started investing it. I started off, I couldn't afford to buy a house. So I wanted to be involved in real estate because I knew the real estate was going to come back. So I ended up buying REITs in that period, right? Because that was the beat down asset. right now there aren't a lot of assets that are beat down. There aren't a lot that are beat down. I don't see a lot of value out there right now. So assets that I'm buying today, I'm really not looking at seeing the kind of returns that I really want for 5-10 years in a lot of cases. So, yeah. So, right. So getting multiple streams of income to get ahead. So REITs are kind of where I started. And then eventually I had enough money to buy my own house. And then the condo we lived in, we turned into a rental property, that sort of thing. And I ended up buying in that time period. It was a really good period actually to buy dividend bearing stocks in that time period too. It's a little bit less of a good time to do that now. But yeah. So Dubs Atron says, "Did you buy Moderna last year?" The answer to that is no. Well, yes. The answer to that is yes, but not enough to really make life-changing money, right? Because so many other people were engaged in this technology too, and the way that the vaccine was developed was actually pretty surprising too. It was, but no, it wasn't enough to like change my life. So SafeMoon August 28 wallet launching, pumping up. Not something I've researched enough on that to comment on. So, but I that's something I'm looking at this point. So Anvar H says, back the truck up here for a sec. Jay, you said you have a boat battery by B. No, it's another. No. The boat battery I have is not by BYD. It's another lithium battery, but it's a lithium iron phosphate battery. One for starting and one for electronics. You probably shouldn't use that battery for starting, but since it's a really small motor, it's fine. But yeah, so it will change the game for boats. You have no idea how much lighter it is and how much weight that I've saved with that. But yeah, it makes a giant deal. So I'm actually already looking at making a battery powered boat at some point. I don't know if I've shared this or not, but on my channel, but boat building is actually one of my hobbies rather. And I just put my 18-foot Carolina Dory on a trailer, and I just need to slap the engine on it and it's ready to go. And I'm ready to start on my next boat. But an electric boat is something that I think is in my future. I'm going to design and build an electric boat that's Coop's rolling. Yo, Jason, what's up? Coop is one of the students at my Jiu-Jitsu Academy. And I'm actually happy that he's tuning into the live stream here. So, all right, Shula's Joe says PayPal could be a good buy the dip play in a recession. I think that PayPal is actually a good buy pretty much for in most cases right now. I think that I wouldn't pay too much attention right now to the specific day that you're investing in. Like I know that PayPal was up at like $299 a share a few days ago, and now it could be purchased in the 270s. I don't know if I'm a long-term investor, I don't think I'd pay too much attention to that. I think that 5 years from now, this is a stock that's worth double what it is today. And I think it's easily worth double what it is today 5 years from now. And I think that if it went down in a recession, and I don't actually see a recession for us happening in the near-time future, unless it's engineered because of runaway inflation. Let's talk about that for a second. That is exactly the response you could expect in the case of runaway inflation, and that would be an engineered recession. And how can I say that? Well, I can say that because I'm a student of history. When you look at the runaway inflation we had in the 1970s, which the causes of that are arguable, but a lot of people think it had to do with the attempted price controls by the Nixon administration. And it caused a couple, and of course, with the oil shock, it caused a number of supply shocks, bad government responses, and suddenly we had runaway inflation. Right? We had inflation. It was just ridiculous by the time Carter got into office, and by the time he left, he was largely taking the blame for that when it's really a function of the wider economy. But what happened is we had a leader of the Fed in place who just had cojones of steel. He didn't care what anybody thought about him, and said the way out of this is to engineer a recession, raise interest rates so high that it causes all of those dollars that are being kept overseas right now and in bank accounts. We're going to bring them back, have them on deposit here. And we're going to reduce the money supply and end inflation. So okay, that's a simplistic explanation, but that's exactly what happened. Paul Volcker goes in, he talks to Reagan, he says, this is what I'm going to do. It's going to cause a recession in your first 2 years in office. And I don't know how that conversation went because Paul Volcker crushed the U.S. economy. I think unemployment went up to about 10% in that time period. And he just didn't care. He just didn't respond to criticism. But it did end the hyperinflation that we had. I don't know that we're going to see that sort of scenario, but you could see if we have an overheating economy at some point and runaway inflation, you could see a response like that, which is an engineered recession. That's not out of the question, right? Okay. Would you advise to park money in gold for the moment instead of cash? Man, Max, so I'm going to admit to being a little biased here. I'm simply not a gold bug. So I worked for a company at one point that had the best performing mutual fund over a 10-year period, and it was a gold fund. And I think it was from like 2001 to 2011. But it was a gold fund, but it was actually a small cap mining fund. And people kind of really misunderstood how that worked. And so they all poured into this fund. Of course, if it was the best performing mutual fund over the last 10 years, it's not going to be the best performing mutual fund over the next 10 years. That's a guarantee. I'll bet on that every time. And how can I say that? Evidence. The evidence is out there. Look at the SPIVA persistence report that's published by S&P. I think they do it twice a year. And you'll see that you should never be buying the best performing mutual fund or ETF in any category. If it was the best performer over the last 5 years, it won't be for the next 5 years. And I can say with a high degree of confidence, because it happens in less than 1% of the cases, that if that mutual fund or ETF was in the top quartile, right, there's a less than 1% chance in most cases, in most rolling 5-year periods, that same ETF or mutual fund will be in this top quartile in the next 5-year period, right? That's not something that people want to hear. That's not something that people want to understand. They want to believe that past performance is an indicator of how future performance is going to go. And it's just simply not true. And there's all the evidence in the world out there to prove that, right? So I got kind of burned on gold because of that, because I had to deal with so many clients who got burned on it. But I find a lot of things sort of confusing about gold. Like I don't know, just like I don't understand brand in a lot of ways. Like I don't understand the power of brand. I buy things that are technologically superior, right? So, which means that I missed a lot of investment opportunities because I didn't understand the power of branding. In some ways, gold is a brand, right? Yes, it has plenty of industrial uses as a conductor, but really it's just pretty, and people have liked to own it since the beginning of time. It never seems to have lost all of its value, but it has a couple of inherent weaknesses. Number one, it's difficult to trade in its physical form. Number two, it doesn't compound or create any income. And so it's kind of hard to really kind of consider it an investment. If you look at the performance of the stock market versus gold over a really long period of time, you're going to see that stocks kind of outperform gold over the long period. But in the short period, I can't really say that it's a bad idea, especially if you're going through an inflationary period. It may hold its value pretty well. There's not a guarantee of that, of course. We've gone through inflationary periods where gold did not do well. We've gone through inflationary periods where gold did exceptionally well, right? So, yeah. Something very heavy. Okay. Chris Palmer says, always good to see you. And now you don't do price targets. Any hesitation on NEO being under 200 a share by 2025? Under 200 a share by 2025? I'd say there's very little chance of NEO being under $100 a share by 2025. So a couple of different reasons why. They are going to face a lot more competition than Tesla ever faced. There's 130 different vehicle manufacturers in mainland China right now. They're all gearing up to produce EVs. Not only that, there's a lot of regional differences that are not really well understood by Western investors. And just because a car company is popular in the north of the country doesn't mean it's going to be popular in the south of the country. There are people in Shanghai who've never even heard of XPeng, right? Pretty much everyone's heard of NEO because they've gotten a lot of press attention. But, XPeng is out there outselling NEO. Li Auto is out there outselling NEO. And if you go to the northern part of the country, there are plenty of people there who have never heard of Xpeng or Li Auto. Part of it is because of regional differences. Part of it is because of regional rivalries, and the fact that the car market in China has been so fractured that there's almost destructive competition there. That's sort of limiting the ability for any company to get a really large foothold in there. Some people see that as beneficial, saying that it should have sparked some degree of technological advancement, but it really didn't. And in fact, it was the CEO of Geely who made this brilliant speech about 7 or 8 years ago on why the sort of contract production model for vehicle manufacturers in China kind of ruined their ability to create technological innovation in the internal combustion engine space. Basically, they were making so much money just providing car parts to all of these Western manufacturers that they didn't incent them to actually create any new technologies. So that's changing a bit with this new class of entrepreneurs who is now heading up these new companies. And I think that's very, very important. So Max P, thank you so much for your super chat contribution. Chris Palmer, thank you so much for your super chat contribution. I really appreciate those. So, so it says it was very heavy. Okay. When I turned 16, I stopped debating people regarding politics. Man, I wish I could say I stopped doing that. Because I wish I could say I stopped doing that, but I haven't. I'm going to try to, though, because it's actually kind of useless. There's no point in debating people when it comes to politics. So out of all of the beat down Chinese stocks, what do you feel that might be the best deal or opportunity right now? So not right now, but what I think is going to be the next target of the Chinese Communist Party is going to be Tencent. And I think their stock is going to get beat down. And I think that buying Tencent, I think I'm probably going to buy some Tencent when it gets beat down. I also believe that Tencent, it's a true conglomerate at this point. They have so many business interests in so many different areas that I think at some point they're going to start becoming an anti-conglomerate and spinning some of those assets off into independent companies when they think they can benefit from that, or when they think those companies would be able to raise money more easily on their own when they have a more mature stock market. I think that as a long-term play, Tencent could be kind of like AT&T. Not familiar with the history of AT&T. AT&T, for folks that have held it for since the 1950s or something, has spun off a dozen different companies in the lifetime of that company. And those people would start off with like 100 shares of this or 100 shares of that or whatever they got. And now they have 2,000 shares of whatever company was originally spun off at 100 shares, 3,000 shares of whatever. And AT&T over time started kicking out these. And there's lots of other companies on the S&P 500 that have done this. I think that is ultimately Tencent's destiny in this case, is they start paying a higher dividend and they start actually spinning off some of what they've acquired over the years. So I think that may be one of the best opportunities out there. I know they're not well understood in the U.S. How far their tendrils kind of go into everything in the Chinese economy. They own a piece of just about everything, right? Including some of the early investors and some of our favorite EV companies. They're known primarily for their streaming services and music and all that, but they have their hands in just about everything from decentralized finance to and I'm reading somewhere they own an antiquing service or something like that. And anyway, they have a huge variety of business interests across China. So have you guys ever heard of Interactive Corp? Interactive Corp is basically the anti-conglomerate. It's what I think Tencent will eventually be, where Interactive Corp goes out there and they buy assets that they think they're going to have value. They develop the brand and then they bring them public, right? I think that's what's going to happen. So basically, Patrick, you say basically a spawner. That's correct. Interactive Corp here and IAC is probably the best example of that. And it's not a great example, but it's the best example of that type of company right now. Now that AT&T is not really doing that anymore. But yeah, it's an incubator would probably be a better word. I think that's eventually what Tencent becomes. So yes, Shoeless Joe, thank you so much for your super chat contribution as well. I'm always curious, like, I'm getting super chat contributions in euros. I'm getting super chat contributions in pound sterling. It's I think it's very interesting that I have an international audience. I don't know why when I started this. I never thought that I would have an international audience, but I think it's very interesting. Anyway, folks, any other questions you guys have about stocks, general economy? I got about 5 minutes left before I need to get off here and get on another business call. Actually, I'm already late for that business call. It's all right. I'm kind of known for perpetually being late to business calls. But China is beaten down already, says Fresh Aquariums. Anyway, Coop's rolling. If you have a question about finance or investing, you can always ask me at the Academy too. I'm happy to answer anything. And if you guys don't train jiu-jitsu, you should. Anyway, I'm going to go ahead. Okay, hold on. What do you think about Lucid? Marius Pastoso says, and I hope I'm saying that correctly. I massacre names all the time on my live casts here. So what do I think about Lucid? I've gone back and forth on Lucid on whether or not I think that they have a product that's going to be good. So here's the thing. I finally have talked to people who've been in the car, who are involved. They're involved. Basically, they work for a venture capital firm that invested in them a long time ago, or did some sort of series financing. I don't remember the particulars about how they got to this, but they actually got to go in and experience the Lucid Air, and it's a fine vehicle by this person's account, right? That's not really the point. What I also got to see was footage of the interior of the factory. So it's very different than looking at footage of the interior of a Tesla factory. And in this way, this is what's different about it. There's a lot of, and I'd seen other footage that made me think this, but when I saw his footage, and this is all coming out, I'm not sure if I can disclose who he works for. So it's all coming out through a document, not like a documentary, but basically like an investor piece coming out on financial media pretty soon. But from what I saw, just further confirm that there's a lot of labor cost in their factory that Tesla doesn't have to deal with. There's a lot of things that are being done by hand where in other factories they're going to be automated. Now, I understand that luxury cars like Lamborghinis are all made by hand, things like that. But yeah, those are $2-3 million cars. The Lucid Air is targeting that same market of gadget friendly people, or gadget friendly people who are high earners who can afford $160,000, $170,000 vehicle. They're targeting that so they can work their way down the value chain. I understand that's what they're doing. That's the blueprint that Tesla laid out for us. Although I don't think that blueprint can be completely reproduced today. I think the market is just very, very different. Okay. So what do I think about Lucid? I think that Lucid has a chance of being successful simply because they're going to be the only other real independent option out there. I, for one, do not want to buy a Ford electric vehicle. I don't want to buy a GM electric vehicle. I want to buy a Tesla. I would prefer to buy a Lucid. I'm not going to buy a $160,000 car, but let's say Lucid made a $40,000 car, truck, or what, and Ford has a $40,000 truck. I'd prefer to buy that Lucid truck just because they're a new manufacturer, a new company. They're advancing technology. They're keeping us sort of on that forefront of technology. Like that's sort of, I want to support that kind of business. I think there's enough people out there like me who are going to take who are willing to pay a little bit more to be a part of that story, right? And I think that's where their success lies. I have someone in my Patreon group who joined my Patreon who made this point a long time ago, and it really stuck with me. And he says that you can walk anywhere in Silicon Valley and all you see is Teslas left and right. And as soon as the Lucid Air is available, there's a certain percentage of that population that's going to say, everyone else has a Tesla, I'm buying a Lucid, right? I think that population is large enough to support this necessarily high margin vehicle and get them to that next stage of manufacturing evolution, as long as they can also manage, going back to capital markets and hitting them up. So as long as the Lucid Air is successful enough, right, that initial product is successful enough, I think they're going to go back and be able to do secondary offerings or offer convertible securities to raise enough money to build that second factory, to develop that second product. And that's where we really start to see them take off. Or it's another one where I think they could be ripe for acquisition and end up being a luxury product line in a larger manufacturer. So so I think that's probably what could happen. Lucid or Fisker? Lucid. Lucid. I do like Henrik Fisker, but Fisker's just had kind of a checkered past. I'm not even clear on whether or not the deal with Magna is actually real for production. I'm not clear where, I understand where they dropped their support for that solid state battery, because they think that the volume production is still 7 or 8 years away. But without what they were talking about earlier, what was really going to differentiate Fisker from all these other people that are going to be in production far sooner than they are, right? So I'm a little bit worried about the future of Fisker. Like, I don't know if they're going to be able to make it unless they can generate enough interest from private equity and enough interest from public markets to be able to go back out and raise more money, right? So I'm a little worried about them. Lucid is a little bit closer to real production, right? So when do you know when is the right time to sell and get profits? How do you make that decision? So I don't do a ton of selling, and I probably won't do a ton of selling until I'm retired, right? I'm still, I'm sort of working, right? I work for myself. I work the hours that I want to. I teach in one of the academies that I own, and I own a couple of other businesses that really just produce where I'm the investor, but I'm not actively involved in those other than I want to know what's going on, right? So I'll start, and I have a liquidation plan in place to create the level of income I need to support the lifestyle that I want, right? So a lot of people, though, they don't have a liquidation plan in mind because they're actively trading in order to generate the income they need to do whatever they want to right now, right? So like, I don't do things based on when a stock is fully valued. I make these calculations all the time. I say, based on price earnings ratio, based on price earnings growth ratio, based on whatever I want to measure by, do I think this company is fully valued at this point? That's generally when I'll stop buying that company. And I'm doing this for the more mature companies in my portfolio, like the things where that actually matters, right? But in a lot of cases, that's not where I have that. So your priorities and my priorities might be completely different. Generating a profit in the short term is never really one of my concerns. My concern is getting to the finish line. The finish line for me is the day my kids are done with college, I'm not working again, right? So very different. So anyway, guys, I do have to go now. This was supposed to be a short 1 hour live stream, and that's all I had time for today. I'm going to try and do more of these. I really had a lot of fun doing this today. And Fresh Aquariums, I'm going to look up HUYA, and I'm going to have a little conversation with you about that on the next live stream. I promise you. All right. So thank you very much, folks, and I will see you next time.